Oh, here we go. Got it.
Uh,
Yeah, Logan Lee has graced us with his presence, so we're very fortunate tonight.
Are you on, Logan?
Yes, sir. How are you, John?
I am fantastic. Good to see that bearded face again.
Thank you, sir.
Let me tell you something. I had to talk to your compadre, Mr. Coffin, this afternoon.
Well, I did
I
too.
got to tell you some news. We had a client event with one of your competitors last week. And they came in, and for one thing, they did an excellent presentation, and they're actually paying the third distribution for 2021. And because of that, I wrote 7 tickets since then. So when are you guys getting back in business?
Oh, wow. Well, we do have some other things going on that are in a different asset class, John.
Okay.
So I don't know if Paul told you, we're doing some DST offerings in multifamily.
Okay.
And some grocery anchored retail. We anticipate bringing some of that out. So very just conservative deals as we continue to monitor the REIT portfolio.
Well, Paul doesn't tell us anything. He sleeps through all the presentations. So
I know.
So we don't get
Just,
him from Paul.
you know.
So most importantly, tell me what Moody REIT II is doing right now.
Sure. And do we have Andrew? Do we have the concentration to begin, or should we wait a couple minutes? What do you guys think?
We got Tom and John with investors in it, and they were actually at our dinner last week with Phoenix American Hospitality.
Okay.
So last week, and some others have asked us to record it, so that we've just started recording. We have a really good Moody client who's traveling in Egypt right now with his wife.
Okay.
Yeah,
wow,
we're good to go.
wow.
We don't, I'm not expecting anyone else to join. I did get one pending response, but I don't think he'll end up joining. So we will just send it out as a video later on.
Yeah, so we're safe now. Paul takes his shirt off.
Well, it is recorded. So.
I can crack this beer. That's it. Okay.
All right, Logan.
Okay. Well, I'll kick us off, and if any of you folks were on our last update, hopefully this will be a refresher and an update as well from our last conversation. And those of you who have yet to join our updates, welcome. I'm glad you're taking time. We're really appreciative of all the patience that our shareholders have exuded over the last 18 months. It has been something that none of us signed up for with the pandemic. We were coming in, Paul and I both were together at a conference in March of 2020, actually it was late February in the first week of March in 2020. And we were really excited because 2020 was going to be kind of the last year of fundraising for the REIT. We were going to close the offering at the end of the year or the first quarter of 2021. We were looking to buy 3 or 4 or 5 at least assets to kind of round out the number to 20 assets, approaching $1 billion in valuation. We were coming off the heels of an increased valuation, as y'all might recall, in 2019. And there we were at a broker-dealer conference, he and I huddling up, talking with some advisors and some clients, just really, really excited. And then we get home, literally, and we just immediately get hit with our downtown Seattle asset being the first asset hit with COVID-19. And as you guys may recall, Seattle was the first market that experienced COVID, and we have a $100 million asset that's located downtown Seattle. So our management company had to roll up its sleeves immediately at the onset of the pandemic. And then it continued to progress throughout the country. And we had a little bit of an advantage after having going through it, before other hotel companies had to go through it for the most part. And we made dramatic choices. We laid off 90% of our hotel staff. The board immediately came together and saw how this thing was spreading and how business travel plummeted and how we were having the government mandating, as y'all I'm sure you recall, the 2 weeks to stop the spread, and travel just stopped. Every conference was canceled in 2020. And so we made the dramatic choice to suspend the offering. So we immediately shut down the REIT offering, so no investors could buy any more shares. We also suspended distributions, which was the last resort, because we know that you guys invest in this thing for income. And we have 8,000 investors like yourselves that are really counting on that income, or one of the options in your alternative sleeve that produces income. And as you guys may recall, we were producing over a 7.5% yield heading into 2020, and that was, poised to continue. And of course, we had to shut down the distribution so we could save our cash, because we didn't know how long it would last. And sure enough, here we are, not seeing each other face to face, although we can more so now, but we are on the dreaded Zoom still. Here it is, November 2021. So it's been a long haul. We are so grateful again for your patience. Again, we have the greatest investors and the greatest advisors that have really been understanding through this whole thing. And so hopefully today I can bring you some positive outlook, as well as just kind of some more clarity as to what we've been going through. We get the question a lot, okay, distributions were disrupted. When are they going to commence again? Because you could go to Nashville, you could go to Atlanta, you could go to, go to Dallas, you can go to Austin, and you can see in these types of markets that there is robust demand for hotels. There are plenty of travelers. So I'll say this, that's true. We are seeing a big rebound in occupancy in our portfolio, particularly in those markets, Nashville, Dallas, Austin, Fort Worth, Houston, and then to a lesser extent, Memphis and Charleston, South Carolina, as well. So we're very grateful that we have these markets that are really resilient to travel, even when business travel has still not come back to where it was. And we don't know if it ever will come back to the exact level to where it was in 2019. So anyway, we are monitoring, we're watching. But since the onset of the pandemic, we immediately worked with our lenders. And so this is the big key that I want to make sure I'm clear on. We immediately entered into loan modification agreements with 15 different loans. And I think there was 7 different lenders, all of which has been securitized. So we're working not with a lender, we're working with special servicers. And so we had to work on loan modification agreements on every loan. And that took some of the loan modifications took over a year. Some of them we are still waiting on documents, seriously, since the pandemic has started. But in the loan modification agreements, we have deferred interest where we're not paying on the loans. We're paying a modified amount. We're paying interest only for a period and not amortization. And every loan's different. I don't want to bore you guys with all the details, but the bottom line is our staff works tirelessly to get these lenders to cooperate as we continue to go through the pandemic. And that was huge. But as a byproduct, you're looking at basically 12 months of a huge deficit where we need to pay back our lenders in order to get out of cash management so that we can take control of the cash as a REIT company, and then we could do distributions. That's the way the steps work. I went over this on the last call. And so think of it as, you're kind of on a peak here in 2019, and then you don't pay, and then it kind of drops, and then you've got to work your way back up to where you were and get an even footing with your under your loan terms. And so that's what we've worked really hard to do this year. I'm proud to say, Paul and I both, that we work for a company that puts our money where our mouth is. And our company has put in over $20 million in a credit facility to provide cash infusions into the REIT so that we could pay for these loan modification agreements. Some of them all have fees and expenses related to going into the mods. And so over 20 million. And I think we're going to have an update next week. I don't know the numbers, but I think it's about 27 million is the final number that we put in this year. And so we're going to be a lenient lender, right? We're not doing this to burden the REIT. It's the exact opposite. we're putting this in there to create a shot in the arm for the REIT, no pun intended, with vaccinations. We are creating a shot in the arm for the REIT so that the REIT could get back on its footing, so that we could have control of the cash and then produce distributions as soon as we're able. Very exciting news. You guys are the first to hear this. We're having our board meeting. What day is today? Wednesday. We're having our board meeting on Friday, and then we're going to finalize our third quarter filing, the 10Q. But revenue per available room for the portfolio is up to $67. To put in that perspective, if you listen to Brett Moody's update from the CEO in the second quarter, RevPAR, revenue per available room, was at $47. In the third quarter, for year to date through the third quarter, it's now up to $67. So we're up 34% from last year. We're 12% higher than our market competitors. So our hotels are doing pretty well.
What was the peak RevPAR in 2019?
Peak RevPAR in 2019 was over 100. It's like $106.
Mm-hmm. So we're not near there yet.
We're not near there yet, correct? But we're outpacing the market. We're outpacing the average competitive set, which is important to know, by 12%. And again, that just speaks to our management team, the brands, the locations, and so on. And so I think that's a big number to celebrate. We're not there yet where we want to be, but we're certainly making gains. In October, we were seeing a good month in October, and so we're excited about that. Nashville is just on fire. So our Embassy Suites Nashville is really doing well. So we're grateful for that. We have a Residence Inn in the Medical Center in Houston that's been doing really well, and we have 2 Austin assets, one by the airport, Hampton Inn, and then a Homewood Suites combination, as well as a Residence Inn by University of Texas, all of which are doing really well, almost pre-pandemic levels. So super excited about that.
At the time Logan, at the time of the shutdown, more or less last March 2021, what was y'all's loan to value at the time? How much debt did you have?
We were at 45%.
So you were pretty low, and
yeah, we were pretty low. We had delevered, so much to the chagrin of Paul and I, who wanted to buy some more assets. In 2019, we actually paid down our debt and delevered, and that ended up being an extremely fortunate move. We had no idea that we'd be in a pandemic, but thankfully we're at 45. So that extra 20 to 25 million infusion brings us to 50% loan to value off that last valuation. So we're still only about 50% all told.
So total, what do you total owe right now in modifications?
I'm sorry?
What do you owe total right now for the modifications to be released?
Oh, the total how many modifications have we done?
No, how much more do you owe before you can release?
Oh, the dollar amount.
Yeah.
It's not as difficult. It's difficult to answer that question because we get every single loan is in different stages. Some have gone through 3 modification turns. Some have gone through 1 turn, all of which have lawyer fees, and you have to pay a percentage and all this. So it varies, but we're in the clear at the moment. I don't think we have anything further at the moment, which is exciting. So we're in good footing.
Let me, and just while we're on the debt piece, Logan, if you don't mind, I mean, John, as you know, one of the things we talked about at length, and I'm sure some of the clients who are on the call now had been in some of those meetings, is that, I wrote down kind of 3 things that really benefited us through the pandemic. Meaning, had we known that it was coming, we likely still would have done the same things. That is, bought in the markets that we were buying in, bought the assets that we were buying, and also deployed the management strategies that we deployed. And part of that is, how much debt we were taking on to achieve the goals of the portfolio. So I think one of the great things about our position going into the pandemic is that we were not over levered relatively. We were in a very good position, from a valuation standpoint, from a market standpoint, from an asset standpoint, also from a debt standpoint. So, that helped us tremendously. And I think one of the great things to keep in mind always about this portfolio, particularly now that we're, 18, 19 months, got almost, 2 years past this pandemic deal, we never gave up an asset. And this industry just got clobbered. And the markets that we were in got clobbered to the extent that it was completely unforeseeable. Worse than the Great Depression, not recession, worse than the Great Depression. So I think, those are good things to kind of keep in mind. And as you guys, as investors, to know that, we were stewards certainly on the front end, with all of the, sort of horizon in mind, sans a pandemic. But because of that stewardship, you're in a very good place now. So obviously not as great as you'd want it to be because it's not paying a dividend, but we're not giving up assets. We're doing the best we can to preserve principal, and continue to keep the portfolio intact. So, and I just think that, tying that debt piece in is a big part of it. So I'm glad we hit on that.
Logan, quick question to you. If RevPAR keeps increasing, say for the next 2 months, and it looks like people are traveling, and I listened to a conference call the other day with Choice Hotels CEO, and I listened to other Starlight Lodging. I listened to with Barry Sternlick. I listened to CEO. Your RevPAR is increasing. If your RevPAR gets up to 80% by Christmas, do you think you'll reinstate the dividend shortly after?
No, I don't think so yet. I don't think so by Christmas. I mean, you're talking about in a month.
Yeah.
But we need a stretch of sustainable revenue growth, and we're in a good position now that we've put those infusions in place, and that we have more control. We're out of cash management or loan modification agreements, but there's a lot of things that have to factor. Now, one thing to consider, unfortunately, we're going to have after Christmas through February is called seasonality. So we're going to have to brace ourselves for a slower end of December through February, but then we're looking to really roar back in second and third quarter. So we're going to keep looking. We're going to be nimble and keep looking. And the moment we're able to, we'll be able to do that. The first step is the board is going to produce a new NAV. So we've ordered appraisals from a hospitality valuation servicing company. So the board is going to look at that and then determine a value in the first quarter. Those of you that have been,
is that the time frame for the new NAV? Is the first quarter?
Yeah, it'll be filed in our 10-K with our audited financials, and that's just a good first step. Once you get that done, you have a value posted. All the frustrations, which we've all been frustrated about with the retirement account showing zero because of them not taking our pricing. It's so frustrating, but that'll be over now that we would have an official posted valuation. So that's good. It's a good first step. And then we're going to keep seeing some growth. All the prognosticators are saying that 2022, we should hit our hospitality demand should recover by next year. And then in 2023, we should see a full recovery in RevPAR. So we're right on track with that. In fact, as I mentioned, we're exceeding our competitive set. So we should start feeling some great tailwinds finally as we continue with bleisure traveler. That's the new word, bleisure with a B. That's the business traveler like Paul traveling on leisure. That's the new buzzword in hospitality. We're seeing a lot of bleisure travelers at our properties, which is good. They're paying good rate and staying the night. And average stay is now to 1.7 nights in our portfolio versus 1.2 pre-pandemic. So you got people staying a little longer, enjoying themselves in markets that we have assets in.
Let's say we get back on skill level where you're paying in distribution sometime early next year. What is the prognosis for the rest of the REIT?
Well, we don't know if it's going to be early next year. To be clear, I don't know. I can't make that determination. I don't even know what our we'll know next week on our quarterly financials. I suspect they're going to be much better than they were in the second quarter. But no, no promises. I don't know when distributions can commence. That's part of the board's. That's the board's decision. With that being said, though, yeah, Paul brought up a good point. We're holding on. We love our markets. I would love to see some opportunities to go buy some assets somehow. So we're looking through creative ways to maybe do that. We'll be in really good shape with our debt. We'll pay back our forborne amounts. We'll settle some of our debt, and we'll be in really good position. And I would see a ratcheted up distribution to clients where, you start low and then starts increasing, and then you'll hopefully see some valuations increase. We're encouraged to see, the highest price per key was ever done was just traded in Napa Valley. We saw Napa Valley Four Seasons traded over $1 million a key. So and then we're seeing Starwood being aggressive. Blackstone and Starwood formed a joint venture to purchase Extended Stay America. I mean, there's a lot of trades that are happening, which is good for valuation. So we're excited about that as well.
Related to that is, I know this is a tough one to answer. When we get the new NAV, which you say will be in the first quarter, do you expect it to be close to what it is now?
Do I expect it to be what?
Close to what it is now.
I don't expect it to be close to where it is now, but and that was because now was 2019.
Yeah.
It was 2019 numbers. I hope it's better than I think. I don't know. We have to see what the appraisals say. Again, I'm encouraged by a lot of these trades that have been happening, but keep in mind, we're not selling. Keep in mind, it's the regulators that are making us value. We're not offering shares to purchase. It's just a paper statement. But it's based on appraisals, and if it comes in low, that means we're not selling. That's kind of the simplified way to look at it. But I know it's not comforting if it's really low. I don't know where it's going to come in. I have no concept of where it could, because it's a really fickle market. You see crazy deals like I just mentioned, and then you see fire sale deals. So it just depends. But I do like the markets we're in. And so I suspect it should be decent.
One of the things to, and actually at the conference that Logan and I were at right before, the world hit the fan, one of our partners, a good partner, was in the room, and a question was asked almost to that akin. And he made a good point. He said, look, when you look at this portfolio, these are hard assets. These are hotels that were producing, at or above average before the pandemic. They're assets that have been maintained, certainly not with the same revenue numbers. But, if you go to these markets, you can physically put your hands on these assets. And, other than the fact that people just haven't been coming to those assets at the same level they were, they're great assets. So for a valuation standpoint, certainly you can't look at them as zero. And certainly you shouldn't expect that they would be anything under what is reasonable to expect for a residence in the Houston Medical Center. And kind of to Logan's point, you're going to get a mathematical interpretation that is likely not fairly representative. But the reality is that whatever it comes out to be, it's not going to be zero. Hopefully it's going to be close to the 2350 that we have now. But there's still really good assets that have whether it's on paper or, the mathematical interpretation, very good intrinsic value. Well above what I think will be interpreted in what comes out come March or April. And I think that again is a testament to, we didn't have to give any of them up. We did a lot of hard work, really tough decisions to maintain the value of those assets throughout this whole deal. And they're coming back, they're bouncing back, just as these markets are. So, it's you get around the block to go across the street on that question, but I think those things are important to keep in mind.
And I'd say I agree with all that Paul said, and I have 2 points that I failed to make earlier, and then I'll open up to any questions that you guys may have. The first is the number one goal that we've had this whole time is to preserve and protect our investor equity, and we've made dramatic choices that are not fun, but all of which has come to roost, and it's been successful. That number one goal has been achieved. That we have 15 hotels they're poised for growth. They're doing much better. We have survived the hardest part of the pandemic, and due to your patience and your graciousness to allow us the time to work on this, we couldn't have done it without your support in that regard. The second point I'll make is, as y'all have seen, this inflation is out. It's going to be out of control, or it could be. Hospitality assets are the number one hedge against inflation, because you can rent your rooms every 24 hours and raise your rates every day. So we have a tremendous asset class to go against this inflationary headwind that we're facing. So that's encouraging as well.
That's about all the questions I got now. How about John, Tom, do you have any questions?
Yeah, this is Tom. I have a question.
Yes, sir.
On one hand, you're saying you're cash poor, and on the other hand, you're saying you're going to go out and buy more assets. Where's this money coming from?
Great question. Good catch too. We're not poised to do that just yet. So we're looking at all options. If there was an opportunity for a strategic disposition of an asset, and then you use those funds to go buy something else, that's on the table. Nothing's in serious dialogue right now. There could be opportunities to take over assets without, where you could do a 721 UPREIT into the portfolio. But you're exactly right, Tom. It's a great question. We don't have the influx because the offering is closed, right? So that the way in which our REIT produces cash is selling common shares, and that mechanism is closed at the moment. So the third option would be at some point to turn the offering back on and restructure the offering to go take advantage of this market. But that's not anywhere close to happening. The first priority is to not dilute the investors, to bifurcate this portfolio, let it marinate, let it grow, and then look to enjoy, let this investor pool enjoy the growth that's going to come out of the recession. But no, we don't have anything. We're not sitting on a bunch of cash at the moment. The Moody credit facility was used as a shot in the arm. There could be an opportunity where we could take on a credit facility as well to go purchase assets. So that's the other option we have. But no, we don't have any cash just sitting there ready to buy assets at the moment.
Thank you.
Yes, sir.
John B, anything? Evidently, he's muted.
Or Carla, y'all have anything y'all want to ask?
Welcome back. Well, then, Logan.
Well, I have something else I'd like to.
Go ahead, Tom.
Well, it sounds to me like we're pretty far in the future yet for expecting distributions. Probably not even the first of half of next year. Am I right on that?
Yeah, Tom, I really don't know the answer. It's the board's decision looking at the financials But that would be my guess. We would need to see out of seasonality and out of cash management and out of seasonality some continued growth that we're already seeing to kind of get us some dry powder to where we could release distributions, dividend payments. So I would guess that we would need a full run in second quarter in order to look to do that. So it's a good guess, Tom. I don't know the answer though.
Just kind of sounds pretty bleak.
Just to add to that, Tom, I think one of the things to be, cognizant of and focused on as far as the distribution is concerned, John had mentioned a competitor of ours who was able to turn on at least some distribution, which is great, which is great.
Don't answer.
Tom, your pizza's here. If our portfolio was, that size with those assets in those markets, and we were able to do that, certainly that would be the strategic decision that we would make. But for where we were and where we are, 600+ million in total valuation, 15 assets and really great markets, it's just a different kind of an animal. So for us, it's very important to be timely and considerate when distributions are concerned, because we don't want to cut off our nose to spite our face. Certainly it's an income generating portfolio, but one of the legs of the stool that runs alongside the income component is principal preservation. Mm-hmm. So if we were to turn on distribution prematurely, where we were not in a financially strong enough position, then all of a sudden we're having a much broader conversation about how much will the overall value of your position start to erode, and we don't want to have that conversation as a 3, 5, 10-year type of a prospect. We'd rather preserve as much as we possibly can from a distribution standpoint to make sure that we're not extending any kind of value erosion almost indefinitely. And so it's a really tough balance, particularly with where we are as the size of the portfolio, the markets that we're in, and the assets that we own. So that's sort of an ongoing consideration. So the frustration is certainly felt across the board, but in our case, we have to be very prudent every time we analyze this to say, hey, yes, we could, and it would feel good and look good to turn on some level of distribution, but it's got to be right. It's got to be right. Otherwise, we're 5 years from now saying, well, why is my NAV where it is as opposed to where it was, if that makes sense.
Yeah, I think I understand your situation. It's just, you understand me as an advisor that I catch a lot of grief.
Oh yeah.
As you can imagine, for the last year, I've caught a lot of grief, and lately I've just had people to say, whenever you get a chance, if you can find a secondary market, sell my shares for whatever you can get for them. And I've had a couple of calls for the last month or so. So that's very disappointing, but I understand your point as preservation of capital to be number one from running a business standpoint. So we understand that. And like I said, I'm just hoping and praying for you guys to keep progressing because, I like to see, like I said, I love seeing NAV posted again. That'd be a big help. And then bottom line, even if you start back a small distribution sometime next year, that'd be great.
Yeah, absolutely. That's the goal.
Are all these assets coming back, or does it make any sense to maybe sell one?
We would be open to that on a few of the assets if we could get a number. Most of the assets have come back. Our New York and Seattle and Philadelphia assets have struggled. They've continued to struggle. Luckily, with the exception of Seattle, it's a smaller percentage of our portfolio. Like I said, Seattle in 2019 valued at 100 million. I mean, it's a very valuable asset. It just has not been performing. It's gotten a little better, but when Amazon wiped out meetings, this was a very Amazon heavy, we call it local negotiated rates. Our local negotiated rate was with Amazon. They had thousands of room nights at this property. And so they just canceled all their meetings with all their vendors and all their team. No one's traveling in and out of there. So it's been problematic, but we've been backfilling it as best we can. So it's gotten a little better, but it's still, it's definitely the lagger. Seattle, New York, Philadelphia. Those are the three big ones that we need to turn around. So Tom, all options are on the table. We would love to reposition, sell some of these that if we can get a number that makes sense, that exceeds our debt, that we're not going to lose, we're going to get some liquidity out of it if we're going to do it. Right. So the board's meeting on Friday. That's definitely part of the discussions. Just so y'all know, looking at dispositions, looking at distributions. And so we'll see what they say.
So Logan, can you send out an update next week on what the board meets?
Yes. And our CEO is going to send out another update video. So that'll be done as soon as the filing's made. We'll send it out on probably a few days after that. All the updates are posted on our website, moodynationalreit.com. We encourage everyone to go to that because we're going to continually pump out updates there. We're looking to do some monthly top line stuff as well. So trying to do some more monthly updates if we can. But yeah, thanks, Andrea. Yeah, it's moodynationalreit.com. That's where all our videos are. You go to updates, and that's the tab that'll get all that for you.
Logan,
We have
and honestly, we really appreciate both of you guys tonight. And like I said, let us have updates next week, and we'll make sure all my investors get it too.
Yes, sir.
All right, guys.
Yeah, we are gonna get cut off here in a couple of minutes just for time link. But thank you guys so much. We'll definitely send this out. And if any of your questions weren't answered, please shoot me a text, give John a text, an email, call, so that we talk to Paul and Logan pretty regularly, so we can get any additional questions answered that you might think of later tonight, tomorrow, whatever.
Absolutely. And we could do this again too, whenever you guys, if you get some more questions, maybe after the filing and now after the holidays, we could do it. We'll keep doing these as long as we can.
Hey,
it's not a problem. We appreciate doing it.
John, so now that we have Logan on, why don't I was in the elf hat at your Christmas party about 2 years ago. I think it's about Logan's turn, don't you think? I mean,
I'd like to see him come with the elf hat. And I think it's time, Paul, you need to come here, Logan.
Well, John says he's not wearing the Santa suit this year, so that's open too.
well,
Right.
that beard can get white real quick, I'm sure.
That would be nice. What a merry time we would have.
Thank you guys very much.
Thanks, guys. Thanks so much, guys.
This was
Thank
great.
you guys. We appreciate it.
Thank you,
Good night.
guys.
Good night.
Bye, everyone. See y'all later.